In Part A of Chapter 7, we were talking about how to assign direct material and direct labor costs in a job costing system. In Part B, we will take a look at how to allocate overhead to these jobs and how to handle job completion at the end of the period. This is a continuation of the tightwire example that we started in Part A. We have some information about overhead costs that were incurred during the month. We used indirect materials, indirect labor, and various other overhead costs, including utilities and prepaid expenses like prepaid insurance, and of course depreciation on factory equipment. How should we handle these overhead items? When we acquire them, we are going to recognize them as part of overhead. So for indirect materials, that means we're going to increase manufacturing overhead control and decrease our materials control by the dollar value of all of the indirect materials that we use during the period. For direct labor, we'll increase manufacturing overhead control and decrease our payroll account by the amount of indirect labor that we used. For the other overhead items, we're going to increase manufacturing overhead control by the amount that we owe for utilities and other factory expenses, by the amount of our prepaid expenses that we used up during the period, and by the amount of depreciation that we used up on our factory equipment. Altogether, we can add that up, and that will also go into our manufacturing overhead control account. Note that this is a significantly different treatment than what you learned in financial accounting. In financial accounting, you were taught that if you had utilities, that would be recognized as utilities expense. And if you had prepaid insurance, that would be recognized as insurance expense. And if you had accumulated depreciation, that would be recognized as depreciation expense. The reason that the treatment is different for a manufacturing firm is due to the matching principle, which says we have to match our expenses to the revenues that they help us to generate. Right now, we are using these costs, but the products that we're making haven't been sold yet. So the matching principle prevents us from treating these as expenses until later on when the goods are sold. Of course, that means that the treatment of certain accounts is going to be very different depending on whether those accounts relate to the factory or relate to the office. For example, utilities that are used in the offices would still be treated as a utility expense, whereas in the factory, utilities costs are included in overhead and assigned to the various units that we make. They become capitalized as part of the cost of those units. Similarly, if we had prepaid insurance that related to the offices, it could be, for example, insurance on the life of the CEO, or it could be insurance against the possibility that one of our sales staff is hurt in a car accident. In that case, we would recognize insurance expense. However, insurance in the factory, insurance against a fire, insurance against the possibility that one of our workers could be hurt, that becomes part of overhead and part of the cost of the units that we make. The same thing is true for depreciation. If it were depreciation on office furniture or computers in the sales offices, that would be treated as depreciation expense, whereas depreciation on the factory and its equipment is included in overhead and capitalized as part of the cost of making these units. So how is that going to affect our T accounts? When we use materials, our materials control goes down and our manufacturing overhead goes up by the cost of all of the materials that we use indirectly. Similarly, when we use indirect labor, the dollar value of our workers' time when they are attending a training session, having a coffee break, or waiting for a machine to be fixed or more materials to be delivered, that is treated as indirect labor, and it increases our manufacturing overhead control account. Notice that payroll actually behaves very much like an asset. That is, it increases on the debit side as our workers come to work every day and punch their time cards showing how many hours they work and how much they have earned. But it decreases on the credit side. It decreases for direct labor that goes into the various jobs that we do, and it decreases for indirect labor, their time spent not working on specific jobs. Altogether, the amount of our workers' time that is used either directly or indirectly must exactly equal the amount of time that our workers were at work during the period. That's why, even though payroll behaves as an asset, you'll never see it on the balance sheet because work gets used up in the same moment that it's created. You can't save it for later. Now let's take a look at other overhead accounts. We're going to increase overhead control by the amount that we owe for utilities, by the amount that we use up of our prepaid expenses, and by the amount that we increase our accumulated depreciation. Notice that overhead control also behaves a lot like an asset. It increases on the debit side. Now we'll take a look at what happens on the credit side. The way that we assign overhead is different from the way that we assigned materials and labor. And the reason is we don't have a good paperwork trail to decide how much overhead goes into each of the jobs that we do. Because of that, there's no clear signal for when to recognize overhead. When we use materials, we have documentation. When we use labor, we have documentation. But for overhead, we have to wait either until we've finished a job, and that's a signal to recognize the overhead that has been consumed by that job, or wait until the end of the period when we need to prepare financial statements. We are going to assign our overhead using a predetermined overhead rate, POHR. There are two main reasons for using this predetermined overhead rate, a rate that we determine before the period ever starts. One reason is that we need to know the cost of a job right away, as soon as the job is finished, but we may not know all of our overhead costs or how many jobs we're going to do until the end of the period. But there's another reason to use a predetermined overhead rate. It's fairer to the jobs that we do. Supposing we have a job and during that job a machine breaks down, so we're going to have some repair costs to fix the machine. If we assign those repair costs to the particular job that we were doing at the moment when the machine happened to break, we are going to distort our own understanding of how much various jobs cost. Using a predetermined overhead rate spreads costs out over all of the jobs that we do and actually gives us a better understanding of job costs. So how are we going to compute this predetermined overhead rate? Each firm has to decide for itself how it's going to dish out overhead costs to the various jobs that it does. There are three common allocation bases for assigning overhead costs: machine hours, labor hours, or labor dollars. GAAP does not tell manufacturing firms which allocation base to use. Instead, it tells manufacturing firms to pick a methodology, use that methodology consistently, and disclose what it is in the notes to the financial statements. Tightwire has decided, for whatever reason, to allocate its overhead costs based on direct labor dollars, DL dollar sign. That means that the firm will assign more overhead costs to jobs that use more labor dollars. Before the period ever started, the firm had to estimate how much overhead it believed it would use during the year and how much labor dollars it believed it would use. In this case, the firm estimated that it would have $600,000 of overhead during the year and $1,200,000 of labor. So at that time, last December, it computed its predetermined overhead rate by taking its estimated overhead, $600,000, and dividing by its estimated labor dollars, $1,200,000. If you put that in your calculator, you get a number, 0.50, which tells us assign 50 cents of overhead to each job for every dollar of labor that job consumes. Let's see how that works. For job 1503, if you look back in your notes, that job used $16,000 of labor during March. At 50 cents per labor dollar, the predetermined overhead rate tells us to assign $8,000 of overhead to that job. Similarly, for job 104, $71,000 of labor times 50 cents per labor dollar says assign $35,500 of overhead to that job. Job number 1505 only used 11,000 labor dollars. Therefore, it is assigned $5,500 of overhead. Altogether, we can add up all of the overhead that we assigned to these specific jobs. It tells us we have assigned out $49,000 worth of overhead using our predetermined overhead rate. We would show that in our journal by debiting, increasing our work in process control by $49,000 and crediting, decreasing our manufacturing overhead control. So let's take a look at how this will affect our general ledger and our subsidiary ledger for each individual job. In the general ledger, our manufacturing overhead control is going to decrease by $49,000, and our work in process control will increase. But that's not enough, because our work in process actually contains 3 different jobs. We need to assign a portion of the total overhead to each job using the formulas that we did on the previous slide. Since it's the end of the period, we can add up all of the old costs for job 1503 plus the new costs of materials, labor, and overhead for each job to determine the total amount of firm resources that we put into these jobs. Now, somebody has to tell us whether we finished any of these jobs. In this case, we finished job 1503 and 1504. That means that their costs have to leave work in process and go to finished goods at the same time that the physical units leave the production floor and go to the finished goods inventory. We decrease our work in process control by the amount of firm resources that are in each job, which we just figured out on the previous slide. Altogether, our work in process decreases by $285,500, and we increase our finished goods control by the same amount. Now somebody has to tell us whether any of our jobs were sold. It turns out that during March, we sold job 1502 that was actually finished before March ever started, and we sold job 1503 that was finished during the month of March, and somebody has to tell us how much they sold for. Remember, whenever you sell merchandise, you need 2 journal entries. One journal entry recognizes that we don't have the goods anymore because the customer took them. In this case, we have to look up what was the value of these 2 jobs. Well, job 1502 was produced for $27,000 and job 1503 was produced for $77,000. And you have that information in previous slides. So altogether, our finished goods control decreases by $104,000, and we recognize that amount as cost of goods sold. But that's not the only thing that happened. We also earned sales revenue because we sold these jobs. Job number 1502 was sold for $35,000. Job number 1503 was sold for $95,000. Altogether, that means we earned $130,000 of sales revenue, and we debit accounts receivable or cash if they happen to be cash sales. The difference between the sales revenue that we earned and what it cost us to produce these jobs represents our gross profit on the sale, and that number will show up on the income statement, but we don't get to keep it all. We would then subtract out all of our operating expenses, our selling expenses, our administrative expenses to get operating income, and then subtract out our taxes to get net income. Now, one more complication. Some firms choose to use two separate accounts for overhead. The overhead control account recognizes the accumulation of overhead items on the debit side, and the overhead applied account recognizes the allocation of overhead on the credit side. At the end of the period, we can compare how much overhead did we actually incur and how much overhead did we apply. If it turns out that the amount of overhead that we applied is exactly the amount that we incurred, we're done. But that almost never happens. In this case, we actually had $51,450 of real incurred overhead, and we applied $49,000 worth of overhead to our jobs, not because we made a mistake, but because we were using an estimated allocation rate. That means there is $2,450 worth of overhead that is unaccounted. Other firms choose to use a single overhead account. In that case, the debit side of the account represents actual overhead, the credit side represents applied overhead, and you come out with exactly the same difference. How are we going to handle this difference? One of our basic rules in cost accounting is that all costs have to go somewhere. We cannot end the period with overhead that has not been assigned to the units that we make. If at the end of the period we find that our overhead control is greater than the overhead that was applied, that means that we under-applied the overhead. In other words, we did not finish assigning all the overhead that existed. On the other hand, it is possible that at the end of the period, the overhead control account might be smaller than the amount of overhead applied. In that case, we over-applied the overhead. In other words, we assigned out more overhead than actually existed. These are not errors. They come because overhead control is actual costs for overhead, and overhead applied is an estimation. Nevertheless, we have to close the overhead account at the end of the period. If the amount of the over-applied or under-applied overhead is small and cost of goods sold is large, many firms choose to make the adjustment for over-applied or under-applied overhead directly to cost of goods sold. Like this, we're going to credit manufacturing overhead control for the $2,450 and increase our cost of goods sold by the same amount. The effect of this journal entry is to bring the value of the manufacturing overhead control account to zero, and it increases our cost of goods sold by this extra amount of overhead that was not captured by our predetermined overhead rate. For firms that use two overhead accounts, of course, the credit would be to manufacturing overhead applied, which would bring the balance of that account exactly to the amount in the overhead control account. Now, if a firm feels that the amount of overhead that has been overallocated or underallocated is very large, or if the firm feels that its cost of goods sold is not significantly bigger than its work in process and finished goods account, then the firm needs to prorate the underallocated or overallocated overhead. Prorating means using percentages to assign a portion of this overhead cost to each of the three accounts. And for Tightwire, this actually makes sense because we can see from the data that I've brought from the problem that we've been working on, finished goods is actually quite a bit bigger than cost of goods sold for this firm. So how are we going to handle this? The first thing that we do is add up the dollar value of these three accounts. Then we're going to use the portion that each account represents out of the total to assign the overhead. So for work in process, it represents $31,500 out of the total, which works out to about 9.2%. Finished goods represents $208,500 out of the total, so it's going to get about 60.6%. Cost of goods sold represents about half of that amount, $104,000 out of the total, so it will receive about 30.2%. It's a good idea after you calculate these percentages to add them up, make sure they equal 100%. We need to assign 100% of the overhead across these three accounts. So how are we going to journalize this? For work in process, we will take 9.2% of the underapplied overhead. That means work in process gets $225 of additional overhead based on our allocation. For finished goods, we're going to take 60.6% of the underapplied overhead. So that account gets $1,485 of the missing overhead. Cost of goods sold gets 30.2% of the underapplied overhead, or $740. So these three accounts increase, and manufacturing overhead control decreases by that total, bringing its balance to zero. Here's a practice problem so that you can try out this technique. A company uses a predetermined overhead rate based on machine hours. Before the period ever started, the firm estimated that its annual overhead would be $120,000, and it estimated that it would use 2,400 machine hours during the period. Your job is to determine the cost of job 0607, which was completed using $4,800 of material, $3,400 of labor, and 85 machine hours. To solve this problem, the first thing that we have to do is to determine our predetermined overhead rate by taking the estimated overhead and dividing by the total number of machine hours. If you divide $120,000 of overhead by 2,400 machine hours, you get a number, 50. That tells us assign $50 of overhead to any job for each machine hour that the job uses. Now we can determine the total cost for this job. We were told the job used $4,800 of materials and $3,400 of labor and 85 machine hours. At $50 of overhead per machine hour, that means we should assign $4,250 worth of overhead to this job. Add it up, and that gives us the value of all of the resources that we put into this job.